Well, good evening to everybody. This is Mike Murphy with CattleFax, and we would like to welcome you all for the Trends Plus webinar here on September the 12th of 2018. We appreciate you taking time out of your busy schedule to listen to some of the information that we've got for you in store this evening. As you look at kind of the preview of what we're going to talk through, clearly, in the course of the last several months, there's been a lot of things surrounding the marketplace, specifically to the trade dispute, trade wars that we've got going on amongst the United States and various countries around the globe. And so we want to be able to walk you through what that looks like and what that impact has been or potentially could be as we look at the market here, not only short term, but even longer term. We're going to go ahead and talk through the feed grain scenario. Had a WASDE crop production report that came out today, and so we'll walk through what we should expect from a grain value in the course of the next 12 months. And then we'll look at the marketplace for the fall of 2019, but give some perspective longer term into 2022 as a cow-calf producer. What should we expect from a price standpoint as we look at things longer term? And then we're very excited that we were able to partner with Elanco Animal Health again. Dr. Nathan Pyatt will be our panelist, and he'll walk through some things relative to production herd health. As we look at the relationship that we've had with Elanco over the last several years, we're very fortunate that they continue to be a big partner of CattleFax, not only for the Trends Plus webinar, but for a lot of other various activities that we work with together. So we very much appreciate their sponsorship, their support, but more importantly, just the partnership that we have amongst the two companies. So with that, our first speaker is going to be Troy Bockelman, and Troy is going to go ahead and start to talk you and walk you through all things relative to trade and feed grain. Troy?
Hello, everyone, and thanks for joining us tonight. This first chart here is just the January through July export and import data from the ERS, and just kind of what's going on year to date relative to a year ago. This red bar here, this is U.S. pork exports, and you can see that through July they're up about 6.5% and about 210 million pounds. When we kind of finish the year, we expect this to be up about 4 to 5%, somewhere in that range. This is U.S. beef exports, and you can see through July, they're up about 15% or 14.9% to be exact, 235 million pounds. When we finish the year in 2018 here, we expect that to be up, about 10 to 11%, So pretty good volume of export growth in 2018 in both beef and pork exports. This is beef exports the last couple years have been performing well, up about 12 to 13% over the last 2 years. Broiler exports have struggled a little bit, but they are still up about 2.6% year to date, about 103 million pounds. We expect them to be up about 3 million pounds by the time the year is over. The one thing we do have here is beef imports is up about 0.5%. They've been up over year ago levels for most of the year. When we get done with the year, we expect them to be about steady or down about 1%. We have strong import demand as well as some increased slaughter in specifically Canada, Australia, and New Zealand, and we'll talk about that here in a minute. So when we go to the next slide here, and we talk about just beef exports specifically. So you can see here, we have had some really strong growth here in beef exports. We are up 14.9% year to date. We expect this to kind of tighten as we go through the year. So when we're looking at this, we had a new record in monthly beef exports in May. June was about steady, and July we had another new record. The main driver in U.S. beef exports this year has been really South Korea, up 45% or 114 million pounds year to date. Japan was a little slow to start the year, but they've picked up the last couple of months. They're up 7.5% year to date. Mexico's up 10%, even with kind of the trade tensions with Mexico. Beef exports to Mexico have been really strong this year. Canada has strong slaughter up north there, and so import demand has weakened a little, and Hong Kong had a really good start in beef exports for the beginning of the year, but the last 3 months have been below year-ago levels and have now are up about 5%. May of 2017, the Chinese market opened for U.S. beef, and since that time, we've really been averaging about 1.5 million pounds per month. So we have seen shipments, and we have seen shipments even with, they put a 25% tariff on U.S. beef. It started in July. We still saw shipments of kind of 1.5 million pounds. That's a developing market. We have the growth hormones, the beta agonists, and the traceability requirements for beef that goes to China. And so that's just a small market, and it is stable at about 1.5 million pounds. Beef imports are, our forecast is about steady. We've seen some growth really in New Zealand and Canada. And when we look at those two specific markets, New Zealand cattle slaughter is up about 6.5% year to date, and Canada is up 7% year to date. So they have some excess beef, prices are low, and are creating some of that import demand for product into the U.S. Australia, beef imports from Australia up about 1%, and their slaughter is actually up about 8%. One of the reasons why we're not seeing as much growth in the Aussie imports is because they are finding quite a bit of value shipping to Saudi Arabia, Japan, South Korea, places like that. And so they're finding some more higher value markets than the U.S. market. Mexico is down about 15%, or roughly 51 million pounds. So we're really seeing a decrease in that kind of that select muscle cut product from Mexico, where we're seeing some of the increase in that little higher grade product from Canada, and then the lean trim from Australia and New Zealand. When we flip to the next slide here, we have a lot of trade tensions going on. I'm sure you hear about all over the news. We have a little trade spat going on with China. We have increased tariffs. We have the renegotiation of NAFTA with Canada and Mexico. And there's been a couple things that have come out with that. So there's a 20% duty or increased tariff, went from 0% to 20% on U.S. pork to Mexico. They also have a 20% or 25% duty on cheese and a few other products like that. They did open a 770 million pound tariff-free quota. So that is about half of the U.S. exports to Mexico, the equivalent of that, are now tariff-free from any other country except the U.S. So they're trying to develop a little bit of other channels to get their pork from. And so, but we'll talk about it in a minute here. Pork exports to Mexico are still looking pretty good. China, we've had an escalation of a trade war with China. Pork duties are now at 78%, and this is up from the normal 25%. They also put a 25% tariff on U.S. soybeans. And, as we all know, we've heard the news about the price pressure we've seen in the soybean market, and some of that has to do with this 25% tariff there. Another developing thing we have here is we have African swine fever in China. That could change the dynamics of kind of that Asian pork market. So when we look at those two countries, specifically Mexico and China, you can see that 40% of all U.S. pork exports are now subject to these increased tariffs. When we look at 2017, or we look at the 5-year average, you can see roughly 30% of all U.S. pork exports go to Mexico, and between 5 and 7% of all U.S. pork exports go to China. So when those are two major trading partners that we have, then we now have 40% of our U.S. pork exports now under these increased duties. So when we look at just kind of the big picture and what are these markets that we have of China and Mexico, how big are they? So when we kind of break it out, and we have a little yearly chart here. So this is U.S. pork exports to Mexico. They now have a 25% tariff on U.S. pork. They accounted in 2017, 32% of U.S. pork exports, or about 7% of U.S. pork production. And you can see this has been a steady growth market here. And we do have U.S. pork exports to Mexico, even with the increased tariffs, up 3% in 2018. But you can see here, the growth that we have here is definitely smaller than the growth we have been experiencing these last several years. So that's important when we look at, Mexico as a pork market for the U.S. You can see China, there's a lot of volatility in China in the export or their imports. You can see that, when they really turn on imports, they really buy from us. You can see that in 2011, 2012, they bought between 600 and 700 million pounds from us. You can see that is about half of the Mexican market, but a significant amount. Same thing happened in 2016. They had record high hog and pork prices in China during that time, and they turned on their pork imports, and they imported roughly 50 million to 500 million pounds. But now they have a 78% tariff on U.S. pork. This is up from the original 25%. It's about 7% of total U.S. pork exports, or roughly 1.5% of U.S. pork production. Because of those increased tariffs, because of the pork situation, the hog situation that they have in China, we have pork exports going to China down about 25%. Before these tariffs came on, it would probably be down about 15%. So we probably lost, about a 3-4% growth in Mexico, and maybe a 10% lessen of a decrease in the Chinese market. So these two markets that we have the increased tariffs, are significant markets that we have. So let's just talk about monthly what's going on. And you can see here, this is just U.S. pork exports. And you can see that we were above year-ago levels in July by about 9%. We're up 6.5% year-to-date. And this would be the first month that we did have increased tariffs. And so when we look at the two countries that we had the increased tariffs to, Mexico was mostly steady with a year ago. And the same goes with China. Well, it's only a 20 million pound market during this time. They were relatively steady with a year ago. What we're seeing here is we're seeing really strong growth to the South Korean market. You can see they're up 42% or 132 million pounds through July. So not only do we see impressive growth in the South Korea market for beef, we're also seeing it with pork as well. One of the reasons why we have this opportunity in specifically the Mexican market is we've had an increase in the value of the peso at the same time as we've had a decrease in the value of the hams. So when we look at this as the boxed ham or the frozen ham, 90 to 95% of all pork exports that go to Mexico are this product. And you can see we converted the ham price to the peso. So there's a lot of volatility week to week, but just over the last 4 weeks, the ham converted to a peso has averaged 5% below a year ago. Last year, there was some strength as we go through this time period here, where it skewed it a little bit. But you can see that since the tariffs were in effect, or July 1st, the ham converted to a peso has averaged 14% below a year ago. So essentially, there's a 20% increased tariff, and the increase in the peso and the decrease in the ham price has absorbed about 14% of that 20%. So it just hasn't had a dramatic impact as you would have thought with a 20% increase in tariffs. So when we look into this fourth quarter area, when we are talking about, so this is a weekly beef and pork production ratio, and it would be the price ratio between the lean hog and the fed steer. Now this is futures applied when we have it into the future. And you can see that we had some extreme ratios in the third quarter of 2018. We've had them before, they've been more extreme, but we had some extreme ratio. And we had the cattle market, or the futures cattle, live cattle futures, been range bound a little bit. And we've seen a little bit of a rally in the lean hog complex. And so that this has come back to still a little bit on the top side of the range, but more normal. What this means going forward is when you're up in this area up here, it'll be hard to get the cattle market to have a significant rally just because the hog market is weighing on the cattle market. We've now seen a little bit more of a normalized situation, or or relationship here. And so that increase in the live or in the lean hog market will allow or relieve some of that pressure in the cattle market. So we talked about African swine fever in China. So this is a disease that they have had pop up in China over the last month. There's now have been 13 instances of African swine fever. Around 1,500 hogs have been died from African swine fever. There's been about 40,000 hogs that have been culled. And the significant thing here is there's no vaccine. And the only way to try to control the disease is through depopulation. Well, this is significant because China has nearly 50% of global pork production and 20% of global pork imports. And as a matter of fact, if you were to take every piece of pork that was exported in the world and ship it to China, that would only account for 17% of Chinese pork consumption. Well, there hasn't been any measurable changes in pork exports yet. With that disease, it's spreading, and it's spreading fast. There has been occurrences up here in northern China, and then there's been occurrences about 2,000 miles away in kind of that southern or central eastern portion of China. And that is spread through trucks and spread through food or animal feed, things like that. It has a pretty long shelf life, and the only thing way to get rid of it is depopulation. The one thing they have there is they have feral hogs, and feral hogs carry this disease. And with those, you look, you see 55% of the world's hogs in China, 433 million head, but there's also 40 million hog farms. Half of these hog farms are 100 hogs or less. Because of that, there's limited biosecurity or no biosecurity in some regions or some farms. And you have the wild hogs that are able to kind of come right up to the pens and spread this disease. Now, the Chinese government, as you know, is a communist country, and they've reported 13 instances. We don't know if there's 13 or we don't know if there's 130, but we do know that this disease is spreading, and it's spreading fast. The Chinese government has banned transport of hogs in these areas, but when you have 40 million hog farms and you ban transport of hogs, it's really hard to regulate that. It'll be really important to watch this going forward, as this can really play dynamics when we think of the U.S. pork when we go forward into 2019 and 2020. If this spreads and this goes into other countries, whether it be Vietnam, whether it be Korea, whether it be places like that, it can really change that dynamic of the global pork picture. That's why this disease will really need to be watched. So not only do we have all this tariff situation going with Mexico and with China, we now have this African swine fever in China as well. There's been other countries in the European Union, like Spain and Russia is another country that have had African swine fever. And, you know, it took 30 years for Spain to get rid of the African swine fever. Russia still has some of the farms that were depopulated were never brought back on to production. And so this will really be an important thing to watch going forward. As Mike said, we had the USDA WASDE report that came out today. They had corn yield pegged at 181.3 bushels an acre. That was up from 178.4 bushels an acre that they estimated in August. And industry expectations were that the corn yield would actually be decreased. So the important thing to look at is here is the USDA sees that there is a corn crop out there and there is record yield. And with that, you know, strong production of about 200 million bushels above year-ago levels. So we do have a crop out there. The crop is looking good, and we have another record yield. So when we switch to the next chart here, and we're looking at, this is the U.S. corn projected stocks to use and the average monthly spot futures price. And you can see they estimated stocks to use, which is total ending stocks divided by demand, and that was estimated at 11.7%. This has been steadily increasing from the 10.5 that they had estimated in July, but this is still kind of below this 12% line. And this 12% line is significant because when you look across this chart, this blue line here, at 12% corn stocks to use, on average, spot corn futures prices are below $4 a bushel. That's important to remember because even though we have a record yield, we had some decreased acres this year, down about 2 million acres from a year ago, production up a little bit, but we have the demand to meet there. We have strong feed and residual demand, strong export demand, and strong ethanol demand. And so because of that, even with a comfortable or, large record yield and a comfortable supply position, demand is there to meet it and has decreased the stocks to use from a year ago. So what does this kind of mean as we go forward through the remainder of the year? So we have here the seasonal December corn futures, and you can see that we put a top in the end of May around $4.25 a bushel. This was also the same time a lot of those tariff news came out and the soybean market dropped a little over $2, and we made a new low down here at $3.50 basis December futures around July 12th. Since then, the market has kind of been range bound between that 350 and kind of that 385 area. When the report came out today and yield was higher than industry expectations, we saw a 14-cent drop in the corn market, but there's strong support here at that 350. Moving forward into the remainder of the year, we'd likely see spot corn futures prices keep that support at $3.50 with resistance at $4.15. When you're looking at the December contract, there is a gap at $4.11. And when you're looking at the spot contract, it's at $3.90. So we have a tighter stocks to use position than we had a year ago. And we have, the energy markets finding support. And because of that, this $3.50 should be significant support in the corn market. So going into the hay prices. So looking over for the next couple months here, we've had a pretty significant drop in stocks or in on-farm hay stocks. We had the lowest on May 1st on-farm hay stocks that we've had since 2013. There's a drought in the western regions of the U.S. The southern plains had a drought through kind of last winter into the spring here. It's currently lessening a little, getting a little rain down there, but still quite a bit of drought down there. In the Missouri area, significant drought. And because of that, hay prices have been a little elevated. You can see that they're roughly, $20 to $25 above a year ago. So when we started here in May, we see them kind of averaging between that, $155 or $160 a ton, kind of through next spring. We have the prices kind of forecast through there, kind of range bound. Seasonally, there isn't a lot of movement during this time period, but it'll still be elevated above year ago. And I think we'll go on to Mike Murphy now.
Thank you, Troy. So what we're going to look at and talk about here today and over the course of the next several minutes is just the outlook for the cattle market. Not only short term as we look in here towards the fall of 2018, but then looking deeper into the winter spring of 2019, and then specifically back to the cow-calf sector as we look out there into the 2020, 21, 22 period during that time frame. So as we start with, and as we always do, we look at the fed cattle market. So the visual here is the Kansas cash price. And we are in the process of bottoming this market for the remainder of the year. And values will then improve going into the end of the year. There's going to be plenty of resistance to this fed cattle market that will initially come into play somewhere out there in the mid-teens. And then deeper into the end of the year, we'll have resistance out there into the upper teens 120 mark. Obviously, there's a couple of factors as we think about the market that could be more influential. Troy highlighted things relative to the African swine fever. Does that start to take on a little bit more prominent role in terms of the impact on the marketplace and what that might mean to the trade situation? So that's something we have to be watching closely. And then looking just a little bit further into 2019, winter weather. There's a lot of forecasts out there, including our own Dr. Art Douglas, that are suggesting that we're going to have more of an El Nino weather pattern, which tends to kind of support a wetter pattern through the Southern Plains feeding region. And depending on the timing of that, can start to create more of an impact to performance of cattle, and ultimately that can start to weigh on the market, where the fed cattle market could perform a little bit better. From a feeder cattle perspective, pretty straightforward here. We have a market that should spend a lot of time in a sideways trading range. This is what we define as a yearling price, basically a 775 to 825 pound Central Plains animal here in the United States. And we should spend a lot of time tracking in here between really 150 and 155 for the remainder of the year. As you get deeper into the end of the year, the expectation would be that prices would decline some. But for the most part, this is going to be a market that's well supported. The driving force behind that will be that the deferred live cattle, specifically that April live cattle futures, as we procure cattle for that time frame in the months of both October and November, will likely be staying at an elevated level, and that will help support this feeder cattle market throughout the next several weeks and into the end of the year time frame. Relative to the calf market, a couple of key things relative to the calf market for this fall. Number one, we are set up, if we can continue into having that El Nino pattern develop deeper into the fall, where the winter grazing prospects look to be very positive, specifically that winter wheat grazing there in Kansas, Oklahoma, and Texas. That will create another level of demand for the calf sector outside of the backgrounders and or cattle feeders. So that's something that will be supportive. What we should find from a calf perspective, and this has changed a little bit when we put the slides together here just in the last couple of days as we evaluate things, and part of that was related to the correction to the corn market here today. But overall, there is risk to the calf market back towards 160, 100 weight for fall lows when you're during the peak of the run in that October, early November time frame. If we don't get that cheap, as we look at a 550-pound steer price, and this would be a U.S. average, we won't be surprised. We think there's going to be plenty of demand out there for the cattle as we evaluate things. So that's the risk, but we could very well stay somewhere closer in a range of 165 to 170 as we look out here into the fall time frame, just based on the underlying demand and the prospects, assuming that they continue to improve for winter wheats specifically, and really all winter grazing as we look across the nation. So that's something we'll be watching closely, but overall a very solid calf market as we go into the fall. And these values, when you look at this on a U.S. average, would be very similar to what we would have seen take place on the summer videos and forward contracts. So again, a very solid, stable market at this time frame. Now, looking a little bit further out there into 2019, specifically on the feeder cattle side, a couple of things are going to be working against us in terms of the value of feeder cattle. The feed yard sector in the U.S. has been losing money since May. And we're now, as we finish off the month of September, this will be the 5th month, or roughly 150 days, where we've lost money. The type of projected break-evens that we've got forecasted going into the winter from October into the February time frame certainly look like the majority of those break-evens are going to be well on top of $1.20 per hundredweight. And so the risk is that the cattle feeding industry continues to lose money on the next turn of cattle over the course of the next 5 months or 150 days. Although these losses likely won't be substantial in terms of where the Fed market will be trading, it still will in fact be a loss. So that's the first thing that we look at in terms of the market that creates a little bit concern for us in terms of the impact on feeder cattle for next year. The second thing that we're looking at is that there's likely going to be a transition as you get into the first quarter of 2019 and even into the second quarter, where the deferred live cattle, specifically the June, August, and October live cattle of 2019, will be trading at a discount to wherever the fed cattle market will be next spring. And that likely discount will probably target these contracts to be somewhere in here in the low to mid-teens. Depending on the type of value of corn, although we do believe, as Troy said, corn will be moving higher into that time frame, we're likely going to be buying break-evens where we're not going to buy significant losses on the cattle as cattle feeders based on the fact that we've gone through this period here, this next turn where we've had feedlot losses. And so the importance of that as we look at things is that can go ahead and create greater risk to the cash feeder market back into this mid to upper 130s area, which is really going to relate back to a fed cattle market a fed cattle break even that's likely going to be closer to the mid-teens as we look at the marketplace. So for those in the stocker segment looking at backgrounding operations, winter grazing operations, we need to recognize that there does appear to be risk based on the assumption that the cattle feeder continues to lose money into the winter of 2019, and that will start to show up in that March through May window in terms of the value of feeder cattle. From where the futures have been trading at in here of late, you would not necessarily define that risk of being significant, but certainly there is still risk out there in the marketplace that we have to recognize. Now, for those that are looking at the decision of, do I buy stocker cattle for next summer's grazing programs now or in the fall time frame coming up here in the next 60 days, or do I look to try to procure that inventory out there next winter and spring going into graze or out into turnout for grass? We believe that if we use the assumption that our fall lows are going to be close to $1.60, the spring high is going to be roughly about 180. You look across in here and you look at that runs pretty close to where the bulk of the years would be in terms of that move from your, again, fall low to that winter spring high. There are specific years that we get a lot more explosive to the market. We've seen that over time. But for the most part, this is the type of activity that we should expect to find in the marketplace. So budget-wise, this can give you a foundation of what that winter cost will be to straighten those calves out, thinking about the health risk, those types of things, as you do go out into turnout next spring. Now, we want to shift gears here a little bit and start to kind of think about where we are longer term with the market. And what we mean by longer term is looking out there in the course of the next few years. We have had a pattern in here as we think about the cow-calf operations where we've been very profitable in the course of the last couple of years when you look at 2017 and then what we should expect to find here in 2018. Recognizing that everybody's cost structure has gone up, and some regions have certainly been influenced with some greater challenges, whether that's feed cost or drought, that can influence your respective regions. But overall, we've gotten along pretty well from a margin perspective. And what this should lead to, as we think about this visual, and what it will lead to, is that the cow-calf sector on the beef side is really going to have fairly stable numbers in the course of the next couple of years. Our calf crop in 2019 is projected to be a little bit larger there in 2018. And as we look out towards 2020, a stable calf crop, because we don't see where there's going to be enough of a significant impact on margins for the cow-calf producer for them to want to look to contract their operations. Certainly, as we've talked about earlier, there are some regions, again, where drought has influenced us. But overall, we feel like that we're in a spot here that over the course of the next few years, this calf crop is going to be fairly stable. So what's going to drive the value of calves as we look at things? And there's two things that will do that. Number one, margin above the cow-calf sector. This specifically is looking at fed cattle, and this is going back for almost a decade. And really the visual that we try to show in here is looking at the relationship that you find when you go through those real extended, drawn-out periods of losses. We know that that correlates back to the value of calves. And then when we go through a period of profitability, it's supportive to the calf market. And so what we want to be mindful of at the cow-calf level is if these margins, in fact, extend deeper into or through the first half of 2019. That is something that would have a direct impact back on the value of calves next fall. And likely, it will to a certain degree no matter what. How large will be driven by how long these losses continue into the year of 2019. So this is something, not only as we look at 2019, but just the cyclical pattern as we think about 2020, 21, 22. There'll be another period out there where we go into a spot where there's some deep red ink in the cattle feeding sector, and that will spill over into the value of calves. So demand at the specific level of who's procuring your calves can have a direct impact in terms of value of those animals. There's also more of the relationship of demand for beef at the higher level, at that consumer level as we look at things. And this chart here has a lot of things that are kind of going on. The left axis, which goes with the blue line, is the value of calves as we go back in here for 25 years, going back into the early 1990s. The right axis, that orange line, is a relationship between the CattleFax 550-pound steer price as a percent of the all-fresh retail price. Now, we know over the long haul that retail values have gone up, and that's been going on since the 70s. That's the same relationship that we have found with calf values. Over the long haul, they've gone up. Part of that is obviously just tied back to inflation. But when you start to measure things since 1999 in that era, which is where we started to take a foundation of demand, where demand had been declining since the 70s through the 80s and into the 90s decade, we turned the corner and we were able to see improvement to demand, and we've been able to see demand overall significantly better than it was those previous years of the 90s decade. And that has held true all the way through here, except for times when we get into recessionary periods. The one that's highlighted here is the 2008 into 2009. You also have that into the 2002 recession, which was obviously created from the 9/11 episode with our anniversary yesterday. And so those are the things that we're looking for in here going forward, is will the global economic environment, the U.S. economy, do we have a recession that's going to come to us here over the course of the next 3 to 4 years when we think about into 2022? And I think all of us would agree, as long as we've come since the previous recession, that those odds are very strong that we're going to go through another. How significant or how strong or how deep is that recession will have a direct influence on the value of calves. And what you'll find is that when you go through a recessionary period, we tend to have to decline retail price to be able to help move the product to the system, because the consumer is just not willing to pay as much because their pocketbooks are tighter. And so that relationship that you find between calves and retail then comes into play, and then it gets even more extreme typically in those periods of recessionary time frame. Now, you can also see when you look at the relationship that maybe a real extremely high corn market could be something that in the next 3 or 4 years, Mother Nature creates in a situation where we draw or drive corn back up to, say, $5 a bushel, $5.50 a bushel. That could have a huge impact on the value of calves. And then, as I said earlier, which was the case there in a couple of years ago, just that long, strung-out duration of extended feedlot losses, then we'll get this relationship to really contract and have an impact on the value of calves as well. So the take-home message in here, as we look at the next few years, the underlying supply of calves as you get into 2019, 20, 21, and 22 is not going to change very much from even where it is this year. We're talking about another 400,000 to 500,000 head increase in calves, and most of that will be absorbed by next spring or next fall. So it will be reflected on the demand for your animals is where you have to be focused in on in terms of the impact on the market. And that demand will be driven by potentially high corn, an extended duration of feedlot losses, or a fairly significant recession, both here domestically and globally. And if those one or all three of those occurrences develop, then the risk is back for this calf market to move towards the lows that were set a couple of years ago, which would be on a U.S. average of about $1.25 a hundredweight. And if that is in fact the case, what we're likely going to find is we start to kind of look at our cost structure. And you can see that our cost structure has been fairly stable the last few years. But if we look at this from a longer term perspective, costs are going up. So this is what could create an environment where we in fact see contraction take place in the cow-calf sector. But it's going to be more demand related than really supply related. And that's not necessarily the case as we look at things longer term cyclically. It's been because we've seen too many calves really get produced. But the way that this cycle has been built, that number won't be that much larger. So we have to look at these outside influences. Relative to our cost sector, what we know, number one, is, and I think this is very clear, through 2019 and on into 2020, one of the most important costs that we've all kind of lost sight of the last several years is interest. Interest rates will continue to go up in the course of the next 24 months. I think that's very clear. The Fed has been very clear about that. And I think that the way that the economy has been tracking and will continue to track into 2019, especially if we get some sort of a resolution with China on the trade dispute, they will continue to raise interest rates. And that's something that can have a huge impact on your cost structure. The other thing that we're looking at from a longer term perspective is just the value of corn and hay. Have we seen the cheapest corn and hay costs behind us? Not that they're going to get significantly higher in the next 3 to 4 years, but are you going to have more of a bias to press the envelope to the top side? So I think, generally speaking, feed costs are going to be steady to higher as well. And those are the two biggest components as we think about this cash cost environment. When we draw in interest and feed costs, those things will be driving your cost higher. I wouldn't expect it to be significantly higher, but certainly somewhat higher as we look at things in the course of the next few years. So as we tie this back from a margin outlook perspective, specifically for 2019 and 20, as I said earlier, costs are not going to decline. Interest rates are not going to decline. Your margins are going to get smaller during the next couple of falls. There's no doubt about that. But they're not going to get hit hard. That risk is really associated with going into the first part of or the early part of next decade. Your supply is not going to be that much larger, as we talked. But you have to be very concerned about a recession out there in the marketplace and what that might mean to us, especially if it ends up becoming a global recession. And that's the period there, as you think about all things coupled together, that we start to have greater concern about margins and where we could see prices, retest the lows that we set here a couple of years ago. And if in fact that's the case, that will lead to a real contraction on margins and likely could lead to start to see where the cattle cycle is in place where we start to see contraction overall. The one thing that could overcome that as we wrap up this discussion is if we can continue to really expand our global footprint for beef around the world. And we can grow our exports. Today, about 10 or 11% of our beef production is exported. If that number could grow to 15, 16% as you look in here towards 2021 to 2, that would be very beneficial. The challenge with that is that if there is the risk of a global recession, that's not likely going to happen. The world's going to go look for that cheaper protein to procure, which is going to be poultry and pork versus beef. But that is something that is longer term very positive. So as you think about past this period of 2021 to 2 and you're looking at your business, this is the key for us. If we can expand our global footprint for beef, that will be very supportive to price in here long term. So with that, I'm going to go ahead and allow have Dr. Pyatt go ahead and talk to us. He's a technical consultant with Elanco, and we really appreciate his time to walk us through some things in terms of just the beef production herd and specifically the influence that Rumensin can have on your operations. So, Nathan, I'll go ahead and run your slides for you, but I'll let you go ahead and take over.
Excellent. Thanks, Mike. Can you hear me?
Yes, sir.
Awesome. Well, we're excited to be a part of tonight's Trends Plus webinar. Glad to be a part of the sponsorship. As Mike mentioned, I'm going to talk a little bit about Rumensin in the beef production herd. Rumensin is not a new tool in our toolbox, but it certainly could be an opportunity area for beef production herds where we're not utilizing an ionophore today in our operations that could help us combat some of those tighter margins that Mike mentioned. The next slide is something that we're really excited about as well is the Rumensin quality advantage. Rumensin is manufactured in the USA in Clinton, Indiana, and we're proud about its consistency, both from the potency of that product, Rumensin 90, but also from the particle sizing. It's a granulated product that we have made that investment in to reduce particle size or reduce the number of fines, but also improve the flowability and mixability of that product into our supplements, premixes, and our complete feeds across the cattle production cycle. From a dependability standpoint, I'll talk a little bit more in a minute about the proven research that we have on the product, but commercially it's an industry leader in the feedlot segment, and again is the only ionophore available for mature cows in the cow-calf segment, and so commercially it's been proven over the last 4 decades. From an accountability standpoint, we look at this from good manufacturing processes and a number of quality assurance protocols that we have in place in the manufacturing of that product that gives us that quality assurance and that quality control measure to provide a good product for you, the customer. Traceability, that gets back to the raw ingredients as we source those, the record keeping, and ultimately trying to put the best product forward as we look from the manufacturing process all the way through the feed mixing and consumption of those products by our cattle. So again, when I talk about Rumensin, it's again not a new product. It's been around for over 4 decades as a trusted solution for the beef industry. There are a number of studies, over 400 studies that are available out there that have proven the efficacy that we have in the product across feedlot, cow-calf, growing cattle, lactating dairy cows, as well as replacement heifers. Many of those research projects focus on our label claims, and those are being around improvements in average daily gain for the growing calf segment, improvements in feed efficiency for both feedlot, cow-calf, as well as milk efficiency for the dairy industry, and for prevention and control of coccidiosis across all cattle segments as well as goats, non-lactating goats. Many of that research projects has also shown some opportunities where we can feed this in combination or have additive benefits with other feed additives, particularly in the feedlot side, like Tylen, Palmitil, and Optiflex. And many of these other research projects have also looked at how these Rumensin can be additive again with other technologies such as implants in both grazing and growing cattle as well as feedlot segments. Ultimately, we've noted some things over the years with Rumensin in terms of feeding behavior, and so we've noticed that we see smaller, more frequent meals that has led to some improvements in performance and digestive upsets, if you will, or reduction of those. And a lot of the things we've learned over the years have really helped refine our recommendations around dose and looking at elevated doses, particularly in the feedlot segment, for improved performance and profitability. So in the next slide, I wanted to get into, again, with a product that's been around for a number of years, we forget often how and why we feed Rumensin and how it works. And so Rumensin is a antimicrobial product that does cause a shift in the rumen bacterial population. And by that I mean that we see a reduction of the gram-positives and an increase in the gram-negative bacteria. Okay, so what does that mean? Well, those gram-negative bacteria have a tendency to produce more propionate, and propionate is one of those 3 major volatile fatty acids that become a fuel source for the animal and create glucose. And so propionate is approximately 2 times more efficient in yielding glucose for the animal, and so it's more energetically efficient for the growth and performance of those animals. So again, when every bite that we consume, we're altering rumen fermentation to benefit in getting more pounds or more growth for every bite of feed that we consume. So some timely reminders, as Mike mentioned, about some of the forecasts we see for our feeder calves and cow-calf margins, as well as Troy mentioned some opportunities with where our hay prices and grain prices are going to be going in the short term and long term both. Just a reminder that Rumensin is the only approved ionophore for mature beef cows, and it's approved for 50 to 200 milligrams. So when we feed that 50 to 200 milligrams, we expect to see a 5 to 10% improvement in feed efficiency. And so when we apply that to a real world situation, we're looking at either improving body condition scores and production on the same amount of forage, or we're looking at improving or maintaining body condition score on 5 to 10% less resources. So as Troy alluded to, the average price currently and going forward for hay prices may be as high as 150 or 160. Certainly in some regions where we've had fortunate rains and good pasture conditions, that's not always the case, but as we increase that hay cost, the value of that 10% improvement in feed efficiency savings is going to be worth more. So in some areas, we're looking at $70 hay prices. We might expect about a $15 net return. for that inclusion of Rumensin at 200 milligrams. Or in other areas where we've got, as Troy alluded to, the West, the Southern Plains, and the Missouri region, where we've gone through some drought stress times. We're looking at 130 or more hay prices going through our winter feeding scenarios, where that value of Rumensin might be worth $25 or more as we look at saving those feed resources when they're costly or sparse. So certainly some opportunities in our toolbox from a technology standpoint to improve our profitability in those tougher times. The next slide is just a reminder on the cow-calf side, on the growing and stocker cattle side. We often use this or refer to this as the rule of two. So when we feed 200 milligrams of Rumensin, we expect that costs us about 2 cents per head per day. And our research data shows that improvement or that addition of Rumensin is going to improve our average daily gain by 0.2 pounds per head per day. And so when we multiply that over a 100-day grazing season, we're looking at 20 pounds of additional sellable weight with those calves. And so Troy mentioned some of those yearling prices being around $1.50. And so for $2, we can get a gross return of about $30 or a net return of about $28 net return over that 100-day grazing season by implementing Rumensin at that 200 milligram level for that feeding period, that grazing period. So certainly, again, some opportunities to add and improve our margin structure as prices are volatile and going forward in the market. So lastly, I'll leave you with this. It's just an overview reminder of what I kind of mentioned already, but just a general recommendation for feeding Rumensin to mature cows is about 200 milligrams. Again, to expect about a 10% improvement in feed efficiency. When we're talking about replacement heifers, the data would suggest we get about a 0.14 pound improvement in average daily gain at that 200 milligram feeding level. Certainly worth some dollars in today's market. And then I mentioned in the stockers and backgrounders, the rule of 2 tenths of improvement in average daily gain at that 200 milligram feeding level. So in the feed yard, we've utilized Rumensin for 4 decades now. And the rule of thumb there is about 1% improvement in feed efficiency for every 100 milligrams or every 10 grams per ton. So we're looking at about a 3 to 4% improvement in feed efficiency over a natural fed program where we don't use an ionophore in that situation. So again, today these are tools that are helping improve our bottom line from across the cattle feeding segment, both cow-calf, heifers, and growing cattle, as well as the feed yard segment. And so certainly some opportunities as we look at going back to those feedlot profitability times being tighter, opportunities to look at and reevaluate our dose, as well as our margins get tighter on the cow-calf segment, some opportunities to look at Rumensin as an opportunity to lessen those negative margins or lessen those downside risks with margins. So reach out to your nutritionists or your feed manufacturer providers to look at how we can implement Rumensin to improve our bottom line from a profitability standpoint going forward. Now I'll turn it back over to you, Mike.
Thank you very much. I appreciate your time here, Dr. Pyatt. And I think there's a lot of good information that all of us need to look at and try to put to use as we think about where our margins are going to get tighter. We're all looking for opportunities to try to improve that bottom line. And certainly for a lot of us traditionalists that maybe we haven't looked at that as closely, incorporating Rumensin into our operations is something we definitely should be taking a look at. We're right on our time spot here of our 1 hour allotment. And so I know at times we'll take questions, and I think what makes the most sense here is that we will please take down these emails of both Troy and myself and just go ahead and shoot us an email for any questions that you may have as we look at things. We do want to mention just a couple things as we look at. We actually have a seminar, risk management seminar coming up here next week. If you happen to want to catch that, we still have a few open spots. We've got our Outlook and Strategy session on November 27th. That's the Tuesday after Thanksgiving. and we look towards, all of 2019. It's a great program. And then our next Trends Plus Cow-Calf webinar will be January 23rd. So, number one, we appreciate all of you taking time out of your busy schedules to be with us. Number two, again, thank you to Elenko and Dr. Pyatt for being here and speaking about the products that they have to try to help your guys' bottom line. And please, again, feel free to reach out to Troy and I for any specific questions that you may have relative to the information that was shared today. With that, thank you and have a great rest of your evening.